Okay, welcome back, everybody. So just to address Adele's question there, should you submit the homework to me? So for these first two sessions, because we're just reviewing the Taxation Ireland syllabus, no, don't submit the solution to me. I will upload the solution. It's actually not very difficult. I am just going to read through it with you to help you along a little bit. But there's maybe one small trick in it. And there's things that if you hadn't revised the F6 stuff, even when you're reading about this, you would start to panic. Okay. So I'll quickly read down through it. Mark, he's age 36. He's a vet. He's a sole trader, prepares accounts the 31st of December each year. He expects that his profit's going to increase by 40,000 per annum. So straight off, you're thinking, well, you're a sole trader, you're taxed on all of your profits. So 40,000 of an increase in profit means 40,000 multiplied by your marginal tax rate they give you there is 48.5%. It's going to go up to 52%. So 40,000 and 52% will be the amount that you pay in additional tax. Okay. So that's the first thing. All right. They do tell us that he's still going to have the same amount of drawings. Doesn't matter what your drawings are. You're going to be taxed on the extra 40,000. Okay. So his tax liability for 2023 amounted to 13,222, 48.5%. So that would have been 40% plus 4% plus 4.5% USC. So he hadn't gone up to the 8% rate. He's concerned about the additional income tax which would be payable as a result of the increase in profits. He has heard that if he incorporates his business, the rate of tax on his profits will only be 12.5%. And did mention that there's quite a number of questions that come up in the exam on the incorporation of a sole trade. And there's a relief and a whole kind of multi-tax scenario that we've got to cover at the advanced tax level. But this is at the basics stage where we want to identify, well, what will be the difference between a sole trader and limited company from the knowledge that we've got from the Taxation Ireland syllabus so far. So if he incorporates a limited company and he takes a salary from the company of 60,000, how much will he pay income tax on? Only the 60,000. If he's a sole trader and his profits are 105, but he only takes 60,000, how much does he pay tax on? 105. Okay. So he's no pension arrangements and recently sought independent advice on the types of pension scheme available to him and how much he needs to invest to provide adequately for his retirement. He's been advised by his insurance broker that he should be investing 40,000 per annum. Now, we were told Mark was age 36. Okay. We've got his earnings, so we can take his income from his trade minus his capital allowances, and we can work out how much relief he will get on his pension contributions. Okay. So he's been advised by his insurance broker that he should be investing about 40 grand per annum into a pension scheme from now on. Obviously, you're going to have to think about, well, how much can you have relief on? All right. He's married with no dependent children, and neither he nor his wife has any other taxable income. So we're asked, based on the projected figures, calculate and explain the total additional taxes, income tax, PRSI, and USC. So you're not asked for his total tax liability. You're only asked for the additional taxes. So on the extra 40,000, which will be payable by Mark if he continues as a sole trader and invests 40,000 in a pension scheme. So what are you going to be required to do? The extra 40,000 of income, that's going to be taxable. It's going to be subject to tax for income tax, PRSI, and USC. He will be up to the 8% rate. So use 52% there. Okay. He's going to make a pension contribution. You're going to have to calculate how much relief can he have for his pension contribution. And then you need to decide what relief he gets for the pension contribution. So I'm kind of giving you the answer here. Does he get relief for income tax? Yes. Does he get relief for PRSI for pension contributions? Anybody? In calculating PRSI, do we deduct pension contributions? No, we don't. For USC, in calculating USC, can we deduct pension contributions? No. You only get relief for income tax for pension contributions. Okay, now again, that's assumed knowledge brought forward from the taxation syllabus. All right. You're not asked for a full income tax computation. You're just asked what's the additional tax liability. And that's 2 marks. Then based on the projected figures for 2024, calculate the total expected taxes, corporate and personal, which would be payable if Mark Riley were to trade as a company commencing from the 1st of January 2024. Now, there is an advanced tax element in this question, so don't bother looking at the solution in the manual because it goes into the advanced tax and you won't understand it, okay? So I've completely ignored that little bit. So all you're going to be looking at, well, if it's a company that has 105,000 of profits and pays Mark a salary of 60,000, what will be the amount of profits that the company has left, okay? And how much tax will be payable on that. So you can assume the capital allowances are the same for the company as the sole trader, and the director's remuneration will be the same as Mark's drawings figure. And again, you're not asked for a full income tax computation. So there's only 4 marks going here for calculate what the tax liability would be. And then you're asked calculate and explain the tax saving arising in 2 if the company were to contribute 40,000 to an occupational pension scheme for the benefit of Mark Riley. Now, will the company get relief for all 40,000? So we'll have established that Mark is not going to be able to get relief for the 40,000 because it will be his net relevant earnings multiplied by his age percentage. And his age percentage is only 20%. So he won't get full relief, but if the company makes that contribution, will the company? Yes, as long as the pension is not overfunded. So when you calculate the profits of the company, after taking off Mark's salary and the contributions to the pension fund, you'll then be able to see, oh, hey, it is better for the company to make pension contributions than the individual. And that's one of the things that we talk about in advanced tax a lot, about tax planning. Do I operate as a sole trader or a limited company? What's the difference between the two? And all of that knowledge comes from the taxation paper. It's just thinking about it differently. And this example actually gets you to see, oh, hey, I didn't realize that when we were doing taxation because they never asked us the question in that way. Okay. So I've kind of nearly answered it for you. I will put the solution up online, but I've put in, when you're answering the question, please don't look at the solution that I put up. Please don't look at the examiner's solution. Read the requirements, identify what are the tax issues. I've done that for you, so you can replay the recording, particularly for those of you that haven't done your exam since 2016 or got an exemption. Use the notes that I gave you to go and have a quick look at, well, what's this stuff about? I don't even remember covering pensions ever, okay? And then give it a go and see how far you get. When you give it a go, if you're miles off, then you know you have a problem. But if you're almost there, you'll have a quick question for me next week. Sandra, when I was doing that homework question, I got this bit wrong. Can you explain that to me? Or when you get the bit wrong and you see the solution, you'll go, oh, duh, I forgot to take off the capital allowances. I know that. I just forgot. I'm out of practice. So is that okay with everybody? Yeah. Okay, great. Thank you. No, kind of wasn't an acceptable answer, but it was nice to ask. All right. So the next thing we're going to look at is capital gains tax. And again, I'm only going to spend about maybe 20 minutes going down through capital gains tax notes, and then I want to bring you to the past exam papers because I want you to see how the stuff that is assumed knowledge comes up. What are you going to have to do between now and the start of the course properly to start revising this stuff so that you can refresh your knowledge and so that you can start to think about it differently. All right. And again, these notes are just, I took the capital gains tax chapters out of the taxation book threw them into ChatGPT, and I said, give me a summary of all those. All right. So introduction to CGT. When do we pay CGT? When there is a disposal of a capital asset by a chargeable person, triggering a chargeable gain. The disposals of assets, when will there be a disposal? Sale is the most common one. Gifts, you'll have seen a lot of at the taxation paper. Exchange of assets is also a disposal, or settlements. Part disposals, we know that we've got part disposal formulas, and then there are certain deemed disposals. The date of disposal is important. So actually in one of the, I think it was one of the papers last year, there was a whole part of the planning in the question that centered around the date of disposal. So you had the financial controller of the company was telling us that, oh, here's the things that are going on, and we're doing X, Y, and Z. Therefore, the date of disposal will be this, and they were telling us what the tax liability was and why they were planning it. And the bit that you had to spot was, hold on a second, the date of disposal is not the date that you received the cash, it's the date that the contract was signed. So no, you're wrong there. That tax liability is actually going to arise in December. So what you're going to have to do is delay the signing of the contract in order to make sure that it doesn't happen in December and happens in January. So that tiny little bit of information there was kind of a pivotal part of that question. If you got that bit wrong, then it kind of had a domino effect on the rest of the question. Administration, as far as payment is concerned, again, assumed knowledge. Withholding tax, this comes up a lot because in the advanced tax paper, we deal with a lot of selling businesses. So we might be selling a sole trade to some third party. We might be making a disposal of a sole trade from the sole trader to a limited company. We might be retiring from a limited company and selling our shares or gifting our shares. We might have assets that are sold from one company to another company. And in the at the more advanced aspects, then you've got reorganizations of businesses where you've got a group of companies and we're going to say, look, we're going to reorganize them and have companies going into different ownership. All right. So this little bit about withholding tax is quite important because it applies to disposals of, it's something that you need to think about and disposal of pretty much any asset. Okay. Once the asset consideration is over 500,000, you need to be thinking of, is there a CG50? If there isn't a CG50, then the purchaser will withhold 15% of the consideration. Okay, so that's an important one that comes up time and time again in exam questions. What are assets? What are exempt assets? Your territorial scope of the individual we talked about already, but don't forget territorial scope of an asset. What makes an asset an Irish asset? Pretty much based on its location. All right. Specified assets were that special category of assets. So they are land and buildings in Ireland, minerals and mineral rights situated in Ireland, assets of a trade carried on in Ireland, and shares deriving the greater part of their value from Irish land and buildings. Okay. So that's a really important category of assets. And again, when we're in advanced tax and we're talking about selling businesses, selling companies, we need to be mindful of specified assets. Okay. When we're dealing with internationally mobile individuals and there's assets being transferred from one person to another, we know that it doesn't matter who you are, where you are, or what you are in the world. If you sell a specified asset, you're paying Irish capital gains tax. We'll also, when we get to capital acquisitions tax, we'll be talking about Irish source assets, which are not the same as specified assets. Okay. Or not Irish, or Irish situate assets. And then we've got some restrictions around development land. Development land, we know, is something that students at the taxation level go, oh my God, development land. How do I know it's development land? You know it's development land if the market value is greater than the current use value. All right. Once you know it's development land, then there's restrictions on the amount of indexation relief, reliefs that normally apply for non-development land assets, won't apply for development land assets. The example we've got there then is your PPO relief. Your CGT computation, there's lots of CGT computations in advanced tax. So you need to know, how do we do a CGT computation? Your consideration, less your disposal costs, less your base cost, less enhancement expenditure, and then down to your less your annual exemption. All right. Part disposal computation, what happens with losses, and then negligible value claim comes up very rarely at taxation, and does come up in advanced tax. Okay. Then we've got shares. So the rules as far as share disposals are concerned are something that you need to familiarize yourself with. This note should be enough. So I don't believe you need to go back and start doing loads of the taxation exam papers. If when you're reading down through these notes, you're going, oh yeah, I remember that, then you're fine. Okay. The thing that comes up quite a bit, not quite a bit, but the things that can cause you a problem in the advanced tax paper is not understanding these basic rules when we build on top of that and we start talking about share exchanges, and then the anti-avoidance provision around your bed and breakfast rules. Okay. Why would anti-avoidance provision come up in the advanced tax paper? Well, often we're looking at opportunities for tax planning. So I've got assets that I'm going to sell. There's going to be a gain in disposal of those assets. I've got some other assets that if I sell them, there would be a loss. Okay, so sell them and we'll use the loss against the gain. But I don't want to sell them. I want to keep those shares. Okay, well, if you sell them and buy them back after a month, you won't fall foul of the anti-avoidance provision. If you had the taxpayer in your exam question come to you for advice, his friend said that he should sell the shares on Tuesday and buy them back on Wednesday, it's an immediate flag for you to go, oh, that won't work. You'll be caught by the bed and breakfast rule. Okay. And then if you're caught by the bed and breakfast rule, what exactly does that mean? And then share for shares transactions was only kind of a footnote nearly at taxation, that if you exchange shares, well, actually both of them are making disposals, but at advanced tax, we learned that there's reliefs that will apply in order to get rid of the capital gains tax liability, and they're examined extensively. Exemptions and reliefs for CGT purposes, so disposals between spouses. Where one spouse makes a disposal of an asset to another spouse, the spouse making the disposal is treated as making it at no gain, no loss. Okay. Now, what does that mean? It means the acquiring spouse steps into the shoes of the transferor spouse and takes on the base cost and acquisition date. So that subsequently, when that spouse sells the asset, they will have the same gain that the spouse would have had if they had held on to the asset. Right. These things are very important because one of the new taxes at advanced tax is capital acquisitions tax. Okay. So in the taxation paper, when there were gifts, you only ever had to think about the consequences for the person making the gift. In advanced tax, we'll cover capital acquisitions tax, which deals with gifts and inheritances. So you're going to have to think about what are the tax implications for the person making the gift, and what are the tax implications for the person receiving the gift. Okay. Now, I'm not going to redo all the CGT stuff because that's assumed knowledge. So when we get to capital acquisitions tax, which we're going to start the course with, and we're looking at, here's all the stuff that we need to learn about capital acquisitions tax, and we go to an exam question. The question will ask, what are the tax implications for John and Mary? And John will be the one that's making the gift to Mary. So we'll be going CGT for John, Mary, capital acquisitions tax, and that will be the new stuff. Is everybody all right with that? So this stuff, even though it's kind of, it would have been, in my opinion, one of the easier parts of the course at taxation. It has much greater importance when we come to the advanced taxation, because we're going to build a lot on it. So that's your spousal exemption. And then the other thing to note about the spousal exemption is that the transfers under a legal separation or a divorce agreement are covered by the spousal exemption. What did I mention earlier on? That when, as far as married persons are concerned, death of a spouse and separation in the treatment in the year of separation was not examinable at taxation level. It is examinable at advanced tax. So we'll be looking for, in the year in which the separation took place, was there a legal separation agreement? Yes, there was. Was there assets transferred? Yes, there was. Therefore, the spousal exemption applies. Or you might have an exam question where, you know, Paddy and Mary are separating. They've come to you for tax advice on the transfer of their assets. They've decided not to engage solicitors because they'd like to part ways amicably. Here's the assets that they're going to transfer from one to the other. Here's the arrangement that they're going to, the informal arrangement as far as maintenance payments are concerned. And the first thing you'll be saying is, well, you need to get your solicitor, you need a legal separation agreement, because otherwise you won't have spousal exemption on the transfer of the assets, and you won't have a deduction for any maintenance payments. And we'll see also that you need the separation agreement on the capital acquisitions tax side as well. Okay. The annual exemption, so 1270, there's a relief mentioned here. So if retirement relief is claimed, you can't have the annual exemption. You might be going, what the hell is retirement relief? It wasn't examinable at taxation level, but it is a relief that comes up in every single exam paper. There is not an exam paper that doesn't test retirement relief. So it's a biggie that we're going to be covering. And when that relief applies, you don't get the annual exemption. Now, there's a big deal made about, oh, because you're getting retirement relief, you don't get the annual exemption. It's a half a mark in the exam. All right. The next one then, principal private residence relief. So principal private residence relief was something that anybody who did the taxation paper, whether it was in the last year or two or even previously, it would have been a question that you knew you had to get down pat, because you were going to get a question in the exam where you had to calculate the capital gains tax liability based on an individual who's selling their home, and you've got all these years where they're moving here, there, and everywhere. When principal private residence relief comes up in the advanced tax paper, you're not quite asked to do as much calculation as planning. Okay, so you've got somebody where you're given their circumstances. Here's what they're going to do. Here's where in the world they're going to be. Oh, and they're selling their house. And when you see what they're doing in selling their house, you've got to identify, well, how does that impact on the principal private residence relief? And based on how that impacts the principal private residence relief, what tax planning advice do I give them to ensure that they don't have a tax liability? And sometimes without even having numbers, okay? Or at least if you do have numbers, the examiner will tell you, don't bother doing calculations. When the examiner says don't bother doing calculations, don't bother doing calculations, because it's a waste of your time. There's no marks for it. All right. So let's quickly revise principal private residence relief. So what does it do? It exempts gains on disposal of your principal private residence. It applies to a dwelling house and grounds of up to 1 acre. What are the conditions? Dwelling house must have been occupied as your main residence throughout the ownership period. Restrictions will apply if the property was used for business purposes. So let's say I've occupied the property for the whole of my period of ownership, and 10% of the property is used for business purposes during that time. Well, then 10% of the gain will not be exempt. That 10% will be taxable because it's been used for business and not as a residence. Okay. If the property is development land, the development land portion of the property will not qualify for PPR relief. So what you need to do there is you need to calculate what is the gain on disposal if it was sold for its current use value. That portion is exempt. The remaining portion is the development value, and that's not exempt. Okay. And then if the property is disposed of as part of a lottery or a game, PPR relief doesn't apply. Okay. I've never seen that coming up in a question, but it was introduced because it was a method that it was a loophole that certain people found to try and avoid tax. So your deemed period of residence, we said that you need to be resident in the property for the period of ownership. But what if you didn't live in the property for the entire period of ownership? You can have portions of periods of absence that are deemed to be periods of residence in the property. Okay, so if you are absent due to working abroad, subject to certain conditions being met. So what are the conditions that need to be met? You might want to jot this down. ChatGPT did too good of a job summarizing this bit. So you must have lived in the house before and after. Okay, so let's just write that down. One second, I'll just give this fella a nudge. Come on. So live in before plus after and no other PPR. Okay, so that condition applies for both of those. In order for you to qualify for that period of deemed residence in the or deemed occupation of the PPR, you must have lived in it before and after, and during that time you did not have another PPR. So absence due to working abroad. If you're working elsewhere in Ireland, you can have the same deemed residence, but up to a maximum of 4 years. The 4-year maximum only applies to working in Ireland. It doesn't apply to working abroad. And then the last 12 months of ownership counts always. Okay. And there's a little bit there about revenue allowing deemed residence for individuals hospitalised or in a retirement home. One of the things that we'll be dealing with in advance tax is inheritance planning. So you might have somebody that wants to get their affairs in order. You know, you might be told so-and-so is 99 and they're moving into a retirement home. They'd like to get their affairs in order, and here's what they want to leave in their will, right? So there might be an issue where there's a home and you're considering, well, if they sell the home now while they're in the retirement home, will they get PPR relief? Okay. Okay, then your development land restriction we've talked about already. The next relief then that we've got here, so this is actually a separate relief, not anything to do with your PPR relief, is the CGT holiday. So this one is referred to as the CGT holiday. So this is where assets purchased between 7th of December 2011 and 31st December 2014, where there are land and buildings in the EU. So it didn't have to be in Ireland. So it's anywhere in the EU. Once you sell them after the 1st of January 18 and you had owned it for between 4 and 7 years, then the gain is exempt. So if you sold it in year 4, 5, 6, or 7, the full amount of the gain is exempt. If you sell it after year 7, then it's the gain multiplied by 7 over the number of years owned that is exempt. Okay. And then we're down to the last one here, then that's your exemptions. from the taxation paper is your revised entrepreneur relief. And we'll end up calling this entrepreneur relief, but technically it is revised entrepreneur relief. All right. So what does this do? It provides for a 10% CGT rate for disposals after the 1st of January 2017. Now, it used to be 20%, but it's now a 10% rate. There's a lifetime limit of 1 million. Otherwise, your gains are subject to the normal tax rate of 33%. What does it apply to? Assets used in a trade or profession. So I've got a sole trade. I'm selling my sole trade. Can I have entrepreneur relief? Yes, that's an asset used in a trade or profession. So subject to the ownership condition being satisfied, entrepreneur relief may apply. And then shares in a company where the individual owns at least 5% and works in a managerial or technical capacity. So this is something that you'll be fishing out information in the question, where you've got to decide, based on the information given, is the person likely to be working in a managerial or technical capacity? So if you're told somebody owns, 60% of the shares, 60% of the shares in the company and works full time in the business, you can assume that they're in a managerial capacity. You don't have to be told what is their title. All right. Why can you assume that they're acting in a managerial capacity? Well, they own 60% of the shares. They've control of the company. Okay, so they're likely operating in a managerial capacity. That came up in one of the questions in the last couple of years, where you weren't actually told what their role was, but you should assume, I think they owned 100% in that case, because they owned the company, and you were told they worked full time in the company, that yeah, they were working in a managerial capacity. Okay. Entrepreneur relief does not apply to investment assets. And it doesn't apply to development land or the business of letting land and buildings. Okay. And then we've got assets must be owned for 3 of the 5 years immediately prior to disposal, and a shareholding requirement is amended to allow relief if held for a continuous 3-year period at any time before disposal. So that's kind of a quick review of your taxation syllabus from a CGT perspective. Now let's have a look at this question. So I've got 2 questions here. Yeah, okay. So we've got 2 questions here. Mary bought a house in Dublin for 30,000 in June 1990 and has lived there ever since the house was built, I think. And it is now worth 200,000. She intends to let the house while she is abroad and to sell it when she returns to Ireland. The cost of renting the property in Caribbean. So I actually extracted a bit too much, or extracted too little. So Mary's actually going on secondment to Caribbean. She's going to be gone for somewhere between 12 and 18 months. All right. So here it is down here, actually. So she's going off to Caribbean. She's going to work there for 12 to 18 months. So you can assume that she's going to live in the house up until the time that she leaves Ireland. Then she's going abroad for 18 months. All right. So as soon as we see that and we're thinking about, all right, if she's planning on selling that house, see that 18-month period, that's going to count as a period of deemed residence, provided she lives in the house before and after. So she must move back in when she gets back to Ireland, and she cannot have another PPO. Okay. The cost of renting in Caribbean is high, and Mary does not like the idea of wasting money on rent. She is seriously considering the purchase of a modestly priced apartment close to the beach. Anybody, any comments? If Mary was your client? Would you be jotting down in your notes? Okay, I need to tell Mary. Yep, that's another PPR. And Mary will say, but it's not in Ireland. How will they know? It is another PPR. Okay, you can't have another PPR and qualify for that period of deemed residence. She intends living in it for the duration of her secondment and then selling it before she returns home. So she's going to buy this apartment, live in it, and sell it in about 18 months' time. All right. So let's see what happens when she comes back. It is expected that on her return to Ireland, Mary will be promoted to vice president role within the AGP group and will join the company's revenue-approved profit-sharing scheme. She has heard that she will receive free shares with the value of 11,000 as part of her package, and Mary is unsure of how this will affect her tax position. Actually, I meant to take that bit out, but it doesn't matter. So as far as her property is concerned, we're not really asked for much in the line of computations. We're asked for advice, and it's 7 marks worth. Okay. So how would I approach this question? We've identified that we've got a problem. She's going to buy another PPR. All right. And when she comes back, I think somewhere in the question, as far as I recall, I think there's some reference to her perhaps not moving back into the house, or perhaps her buying a new house when she comes back to Ireland. So can we assume she will buy a new house on return to Ireland, and sell the old house? Okay. So we're asked, advise Mary on the availability of principal private residence relief on a future disposal of the house in Dublin and outline any tax planning opportunities available in this regard. So I'm going to go down through kind of what I can put in as a solution to this, because I want to show you how one of the topics that you should be very familiar with, how you change your approach to answering the question. All right. So what I always start off with is, well, in the absence of any relief, you'll be subject to 33% of the gain and disposal of the house. And that's a thing that you'll hear me saying over and over and over again. That's where we're starting with first principles. This house is an asset. When you make a disposal of an asset, what tax applies? Capital gains tax. What's the rate? 33%. Okay. So if there's no relief, you've got 33% on your gain. So now we identify, is there a relief that applies? Yes, there is a relief. Principal private residence relief applies. And you need to give an explanation, because you're going to be writing a memo to Mary. Mary doesn't have a clue what principal private residence relief is. So PPR relief provides an exemption to this tax based on the period of occupation versus the total period of ownership. Okay, so I'm not giving Mary a formula. You calculate the gain by taking the gain multiplied by the number of months occupation over the number of months ownership. I'm just making an explanation to her. It's based on the period of occupation over total period of ownership. All right. So then we need to start telling her that you could fall foul of the conditions for deemed occupation if we don't have careful planning. All right. Here's where I'm earning my fees. When we say careful planning, we mean expensive planning. So without careful planning, a portion of your gain could be taxable, since you won't have occupied the house during your secondment abroad. All right. In order to qualify for the deemed period of occupation while working abroad, 2 main conditions that need to be satisfied are: you occupy the house both before and after the overseas assignment and has no other residents eligible for PPR relief. All right. She's buying the apartment in Caribbean. Therefore, she will have a residence eligible for PPR relief. All right. Now, to ensure that, how long has she gone for? 18 months. So to ensure that the PPR relief is availed of in full, what do we need to do? She must occupy the house upon returning before selling it. So Mary, when you come back to Ireland, move into the house before you sell it. And don't buy a property in the Caribbean. So here's where we're asked to think. What's Mary going to think of that advice? She told us, I'm going to buy a property in the Caribbean. They're relatively cheap. I don't want to waste money on rent. So if I buy it and then I sell it when I come home, I'll get my money back. Can anybody think of a way that she can sell her house, get full PPR relief, and still be able to buy the house, the apartment in the Caribbean? I'll give you a clue. It's to do with timing. Yeah. Sell it before she leaves, or does it have to be before she leaves? Could it be a little bit later? So does she have to sell it before she leaves Ireland? Or is there any period of time that will always be deemed?
She sells it 6 months after she's left Ireland, then the final 12 months will be deemed as occupied.
Within 12 months. Yeah, exactly. Thanks, Josh. Joshua. I don't know whether to call you Josh or Joshua. I have a couple of people in work. I keep looking at Jessica's name and I keep going to call you Jess. And then I have a friend of mine, Joshua, and he's Josh. So apologies if I abbreviate your name. You just have to remember not to. Is it okay? Thank you. So the alternative, so Jess and Jessica and Josh are right. If she sells before the 12 months are up, okay, then the PPR relief will apply in full to the disposal of the house, and she can buy her house in the Caribbean and she can get PPR relief on that one as well. Okay. And that was worth 7 marks. And it was pretty much put down conditions, and then the last 2 marks would have been for the alternative. How do we solve the problem? We've got a problem in that we're not going to get this 18 months because she's not going to move back into the house when she comes back. Okay. And it's not even 18 months, it's the problem. It's 6 months of the 18 months because the last 12 months counts. All right. So that's PPR relief. And PPR relief comes up quite a bit, particularly in relation to gifting of assets and inheritance planning, because you've got somebody who has a house and they're going to give it to a relative. We're thinking about what are the CGT implications for the person making the gift, and what are the capital acquisitions tax implications for the person receiving the house. Capital acquisitions tax is the new tax, and when it's tested in your exam, you'll be asked for both sides. All right. We won't be going back and redoing PPR relief. We'll just be saying, remember, PPR relief will apply in CGT. Well, there's about 4 marks, 5 marks worth for that side of the answer. There's this many marks going for the CAT side. Okay. So the next one then we've got is December 2014, Robert Jones. So you should assume that today's date is the 10th of October 2023. Now again, this is a much bigger scenario, and I've taken bits of this question out so that I can show you how the taxation assumed knowledge is built on. All right. Your client, Robert Jones, he's age 62. He's married with 3 adult children. He's currently contemplating several asset disposals and has sought your advice on the following matters. So he owns the entire share capital of Augusta Limited, an Irish incorporated company, which consists of 1,000 shares, which cost him €10 each. So 10 grand is the total cost of this company. He set the company up in March 1998. So he'll be using the 97-98 indexation factor to calculate the amount of any gain. The business of Augusta Limited is the manufacture of sports equipment. Manufacturing premises have been owned by Robert personally since March 1998 and cost $245,000, during which time the entire premises have been used for the purposes of Augusta Limited's trade. So let's stop there for a second. What do they mean, used? So he owns the premises, he owns the shares in the company, and the company uses the premises. Can you give me another word or phrase to describe that? How does the company have the right to use the premises? What must the company be doing? Renting. Very good. Okay. And if you've got an asset that you're renting out, what type of asset is that? It's not a trading asset. That's an investment asset. You're earning case 5 income from that asset. All right. So manufacturing premises are owned by Robert. So we've established that's an investment asset. And he's letting the premises to the company, which the company is using for its trade and it's paying rent on. Augusta Limited is currently valued at 1 million. All assets held in the company's statement of financial position are business assets. Now, there is another relief that is relevant here that I'm not covering. It's advanced tax, but we don't need to cover it to be able to deal with the issues that I've extracted. The manufacturing premises owned by Robert are currently valued at 500,000. Robert's son, Padraig, has worked in the business for the past 10 years, and Robert intends to gradually pass on ownership of the business to Padraig. Now, in this question, you would have been asked, what are the tax implications for both Robert and Padraig? Tax implications for Padraig are the capital acquisitions tax, the new stuff. Tax implications for Robert are not new. They're just CGT. Okay. So the following is the proposed timescale. So on the 31st of August 24, he's going to give 300 shares to Padraig. Then he's going to give him another 350 shares on the 31st of August 2025. Then the 30th of June 2026, he's going to give him the premises and the remaining 350 shares. We're also told he owns a house. I'll come back to the house at a later point. So in requirement A, explain the various tax issues and calculate any liabilities based on current values. So we don't know what the value of the shares are going to be in 2025 and 2026. You don't know what the premises are going to be worth 2025 or 2026, but taking the current values into account, go and calculate the tax liabilities. So in connection with Robert's proposal to transfer the shares in Augusta Limited and the manufacturing premises to Padraig. Okay. And you're asked, explain the various tax issues. So there's more than just CGT and CAT going on here. There's another advanced tax that you wouldn't have covered before, stamp duty, which we will be covering later on. So 4 marks is what is going for dealing with Robert's tax liabilities, which is the CGT. Okay. So let's see, can we get those 4 marks? I'm going to drop in my solution that I did earlier on, and then I'll explain it as I'm going along. What's my first sentence? Can anybody tell me? What's the sentence that I'm going to start with?
In the absence of any relief, there'll be capital gains tax for the 3% of asset.
Exactly, yeah. So in the absence of any relief, he's going to be subject to CGT at 33% on the gain and disposal of shares. We're starting with first principles. One of the things the examiner is looking for is that you logically build your advice, okay? The other thing that I like about these kind of sentences is sometimes when you're dealing with a big scenario and it's kind of like, oh, where do I start? Well, you go down to the tax heads, and for each of the tax heads, is there a tax charge? Yes. In the absence of any relief, there is a tax charge of this amount, but there's a relief. Here's the conditions. Are they satisfied? Yes, give the relief. Or if they're not satisfied, no, don't give the relief. Okay. So there's a kind of a logical methodology for moving through giving the advice. All right. If there was no such relief, we wouldn't put in the absence of any relief. We'd simply put in there is a tax charge and this is what the tax charge is. All right. So in the absence of any relief, it would be subject to CGT at 33% on of the gain. Is there any relief that could apply? So let's deal with the disposal of the shares first. Is there any relief that could apply to the disposal of the shares? That we know from our Taxation Ireland, and we just covered it. Yep, your entrepreneur relief or your revised entrepreneur relief. So we identify the relief and we state whether or not the conditions are satisfied. Robert will qualify for revised entrepreneur relief on the basis that he has satisfied the following conditions. He owns 5% of the ordinary shares. He actually owns 100%. He spends 50% or more of his working week as an employee director of the company for at least 3 of the 5 years prior to disposal, and he's owned the shares for at least 3 continuous years. So conditions satisfied, therefore he's getting entrepreneur relief. Now we need to watch and make sure that he doesn't go over the 1 million, because once he goes over the 1 million, then the 33% rate will apply and he no longer has the 10% rate. All right. How am I doing for time? I'm doing fine. So disposal of shares, I'm not going to make you calculate the gains. I'm going to do it for you. No, not that one. Okay. So we've got, I'll just make this a little bit smaller. So we've got August 2024, he's going to dispose of 300 shares, then August 25, 350, and then August 26, 350. He's making the disposal to his son, Padraig. I don't care whether he's getting any money or not. We know he's gifting them, but whether he gets money or not is irrelevant. It's a connected person, so consideration will be market value. Okay. So this is 71. Okay, so we've got 300,000, then 350 and 350. And that's simply taking the value of the company. We're told it's worth, what was it, 1 million for 1,000 shares. So each share will be worth €1,000. Okay, 10,000 euro. Then our base cost. Now what I've done is I've indexed the base cost in the cell, so you'll be able to see that for yourselves. Oh my gosh, why is it not doing that? So difference. Equals 65. 9. The formulas are a bit all over the place. There we go. So just in case anybody was wondering, where is that coming from? It's the 300 shares multiplied by the cost of €10 per share multiplied by your indexation factor. In the exam, frequently you'll be preparing this as an appendix. Okay, and you'll have your advice in one section, and then you'll be referring to your appendix. So we've got gains of, there's nearly 350, we're up to nearly 700, plus another 295. We can do a quick check to see, are we over the million? So we're at 983,870. So we're not quite over the million. Right? Therefore, all of the gains will be subject to CGT at 10%. Is that all right with anybody, with everybody? Anybody got any questions? No? So that's the shares. And then don't forget, also in 2026, he's giving him the premises. So let's go back and find the premises. They're currently valued at 500,000. He purchased the premises in March 1998 at a cost of 245. So premises. We've got consideration, 500,000. Index-based cost. $245,000 multiplied by indexation factor, I think it was 1232. Got that right? Yep. So we've got a gain of 198,160. Can we have the annual exemption against that as well? I know it's only 1270. How many annual exemptions do you get a year? 1. So no annual exemption is available against the disposal of the premises. Now we will talk about in a second how we could have used the annual exemption differently and made another little saving, but it's a tiny amount. So as far as same person is concerned, that's not the reason why we can't have the annual exemption. The reason we can't have the annual exemption here is that this is another disposal in the same year. Okay, so you get one annual exemption for an entire year. And whether you've got one disposal or 40 disposals, you still only get one annual exemption of 1,270. And when it's gone, it's gone. Okay. So we've got a gain of 198,160. No annual exemption left because we've already used that year's annual exemption. Can anybody tell me what rate of tax is going to apply? But it's either 33% or 10% or both. So, can you help me with your name? Is Anselmo, is that correct?
Yeah, perfect. Yeah.
Thank you. So tell me why 33%. You're correct. So can you tell me why?
Because it's the percentage is applied for the gain.
Say that again.
When you have a gain, you always apply for 33%.
But why can't it? So here we had gains up here and we gave 10%.
Yeah, it was one of the questions I was going to request at the end because I didn't know why it was only 10.
Okay. So, the reason that we gave 10% up here was because he qualified for entrepreneur relief. And entrepreneur relief reduces the rate of tax to 10%. So therefore, the gain on disposal of the shares will qualify for the 10% rate under revised entrepreneur relief. So I'm just going to put REO. Okay. So, and I'm not deliberately trying to get you to make mistakes. I'm trying to tease out these things because these things are things that trip us up in exam. So Dervla and Grace, great that you're acknowledging the cap of 1 million on entrepreneur relief. All right. But I want you to rethink based on the type of asset.
It's an investment property, so it's exempt from any relief.
Yeah, it's an investment property. So what did we say about the premises? And remember, the examiner didn't spell it out. Like that, the examiner just said he owns the property and the property is being used by the company. So we had to fill in the blanks there. What being used by the company? Also, the property is being rented to the company. He's receiving rental income. So that makes the property an investment. Oh, and you can't have revised entrepreneur relief on investment assets. Okay. So we need to tell the examiner that CGT at 33% applies. And revised entrepreneur relief does not apply. So remember, we're doing a report, we're using our words. Does not apply to investment assets. Okay. Now, there is more going on in that question, which is the advanced tax stuff that we will be covering, but all of this is assumed knowledge. Okay. So if the property was owned by the company, would it be 10%? Okay. So I do like when you start thinking about, well, what if this, could we save tax? All right. But I want to make sure that we don't fall into traps. So if the property was owned by the company, then the value of the shares would be higher. So the value of the shares would then be 1.5 million. And the cap of 1 million would apply to the gain on disposal of the shares. The balance of that would have been taxed at 33%. Okay. Yep. So if the company owns the property, then what's he selling? He doesn't own anything except shares. Do the shares qualify for the relief? They do. So, yep. Entrepreneur relief all the way with a cap of 1 million. And that 500,000 brings the value of the shares up over 1 million. So if we were asked, is there any tax planning at all that we could do here? There'd be no point in us saying, well, put the premises into the company so that you can get entrepreneur leave, because it's already at 1 million. Now, if the value of the shares was, say, 450,000, would it be worth having the premises in the company? Absolutely. But then when he transfers the premises into the company, he's going to have a gain anyway. So it is important to ask those questions, because then that's when we go, oh, but you could do this. And then you get the entrepreneur leave. But when he sends it into the company, he's going to have CGT on it. Oh, okay, that doesn't work either. All right. That's part of the learning how to do tax planning, learning how to do the advanced tax, is thinking about the things and going, oh crap, no, that doesn't work. Okay. There is one teeny tiny tax planning measure that could save a couple of €100 in tax. Can anybody spot what it is? These two are happening on the same day. Who says I have to use the annual exemption here? I can just bring the annual exemption against the gain tax at the highest rate, and that saves me tax. And then, Justina, you could say, well, sell the premises next year and get another 1270. One of the things in the advanced tax is now, and that does save tax, but really, would you go to those lengths of delaying the, and I wanted you to say that because I want us to think about how we can plan, but then the commercial rationality has to come into account, and your examiner expects you to think about the commercial rationality. Sometimes there is a correct answer, just like Justina has said, but it doesn't make sense to do that because he has to wait another year to transfer the premises. Okay. And then there are other questions where you're asked, he can't decide whether to transfer the premises now or later. And it's all about the rental income from the premises and, you know, how much money he has and pension income and all that kind of thing. So we want to get into the habit of asking lots of questions, following the scenario through, thinking around about all the different legs of a transaction. And that will help us then to start addressing those kind of issues. Okay. So we are we're not really finishing early, are we? First of all, before I wrap up, does anybody have any questions on this one here? So, and Selmo, you said that you didn't really understand the revised entrepreneur relief.
Yeah, so I'm gonna have a quick read, and then next week, if I'm still in doubt, I can check with you again.
Yeah.
It's okay.
And for anybody who doesn't have a taxation manual that they can look back to, Revenue's website is an excellent resource. So you can log into Revenue's website and you can look up revised entrepreneur relief. If somebody said to me, will you give me some additional information for me to study on revised entrepreneur relief, I'd just go to Revenue's website and pull it. Now, it is covered in your textbook, but if there's any aspect of the taxation syllabus that is not covered again in detail and you think, I'd like some more information on that, Revenue's website is a really good resource. So while you're waiting for the next class, you can go and you can check those kind of things. All right. Okay, so that's all we have for tonight. You've got a homework question. As I said, don't need to submit it to me. I'm going to put the solution up on Moodle. You can go and access the solution. so you can check afterwards. It's more to get you thinking. All right. The other thing then that you've got for homework is I need you to go through, there's 21 pages. That's all. I've taken the whole of income tax and capital gains tax down from over 100 pages to 21 pages for you to summarize. If you go through those between now and next week, if you divide those up into even take 5 days between now and next week, that's 4 pages a day. That's nothing. That's less than half an hour on Instagram. All right. Okay. On that note, I will say good night and I shall see you next Wednesday.
Thank you.
You're welcome.
Yeah, thanks, you.
Thank you.
So I'm just catching your question there. Natalie, is there notes like this? There was this class for next week class. Yes. I haven't pulled all the questions that I want to use yet. But they will be up there before that. They probably go up around about Wednesday morning, Wednesday afternoon. Okay, somewhere between morning and lunchtime. All right. And then was there anybody else? Let me just cut the recording in case anybody has questions.